Hey YouTube, my name is Nick and welcome back to my channel. Today we're going to be talking about the current state of IPOs in the stock market in the United States. And when we take a look at IPOs, we can really compare them to how they have performed historically, and that has led to actually certain crashes in the stock market and other certain events. And so we can kind of analyze what's going on currently and compare it back then and to see if that's kind of what things are leading towards. 2020 has been a crazy year for initial public offerings. There's been some super popular ones out, Doordash, Snowflake, Airbnb, etc. People are going crazy investing in them. There's a lot of hype surrounding them. Personally, I don't invest in IPOs, but I enjoy watching from the sidelines and sort of analyzing what goes on with them, like what investors tend to do and how they tend to think when these IPOs come out. And so a big focus of this video is we're going to be comparing the current state of the market and how IPOs are performing with the dot-com tech bubble of the 1990s to 2000. And we're going to kind of see how those two compare with each other. So as usual, quick disclaimer is that I'm not a financial advisor, nor am I providing you with professional advice. These ideas are only my opinions. You and only you are responsible for the decisions that you make with your money. So we should start the video off with sort of going over what an IPO is, just in case anybody's not familiar, and so we're all on the same page when we talk about them. And what an IPO stands for is Initial Public Offering. And so it is a company that goes from the ownership of a few private individuals or venture capitalists to public ownership of the company. So you start to see that company on the stock market, investors can invest in it. The public then owns that company when a company decides to go public and offer shares on the stock exchange. So Investopedia, a more technical definition, defines an IPO as the process of offering shares of a private corporation to the public in a new stock issuance. And there are a lot of benefits to going public. The main one is that companies can raise a lot of capital really fast because people are just going to invest in these companies, and it's a lot more accessible by the public instead of just having a few private big investors. They just have millions of everyday investors that are just constantly pumping money into these companies. And so there's a big process behind going public, but if I could just dumb it down into a sentence or two, it's that there's a Security and Exchange Commission evaluation, and they sort of look at the strength of the company, if it performs well in its market, if there's a lot of room for growth. And then once the SEC approves of that company going public, then some underwriters will be hired whose job is to determine the price that company will be offered on the stock exchange. So for example, Airbnb was offered at a price of $68. Now it's really hard to get initial public offerings at this price because they are first offered to anybody who had stake in the company beforehand. So it's those ventures capitalists, those private investors. And so they get the first dibs at the stock, and then the price just keeps rising and rising, and eventually the demand's going to exceed the supply. And so it's super tough for just everyday investors to get their hand on these stocks at the IPO price. Now, this is what the IPO market looks like in 2020. Now, there's been a lot of hype surrounding IPOs in 2020. Like I said, there were some big ones this year, such as Doordash. There was Snowflake, which was that big cloud-based tech giant. Airbnb, the room sharing app. There was also like Roblox, which is a super popular video game. They decided to go public. And this year has seen the most initial public offerings double in price since the tech bubble of 2000. And the tech bubble of 2000, let's just analyze that for a second. So all companies wanted to get into the public sector. They really wanted to raise money. And during the year 2000, over 180 companies doubled in their first day of trading. And so what this eventually led to was a crash because investors were extremely overvaluing these companies. Now, companies that were making a couple $100,000 in revenue each year, investors bought into them so much they were valuing them at billions of dollars. It's because the internet was just starting to become super popular, and people thought that this was going to be a super easy way to make money, so they were just pumping money into this market. What happened eventually is all bubbles must pop. That's why it's called the tech bubble. In April of 2000, I believe the NASDAQ lost 35% of its value. Now, the NASDAQ's a composite of a bunch of tech stocks, and so they all just crashed in 1 month. And this is because the companies that people were investing in, they weren't making money. They weren't really good investments, but investors weren't looking at that. They were just looking at the fact that they were internet-based, and that was a sector that was growing or could be big in the future. Now, the good news for 2020 is that they've only seen 19 initial public offerings double in value in their first day of trading, which is way less than 20 years ago. Now, in the beginning of the video, I did say that I do not invest in IPOs personally, and I'll just give you guys my reasoning for that. Now, I read a book called The Intelligent Investor by Benjamin Graham, and it's actually Warren Buffett's recommendation for the investing strategy that he uses called value investing, and so I read it. One of the things that he writes is, some of these issues may prove excellent buys. The issues he's talking about are the initial public offerings. And then he says a few years later when nobody wants them. And so basically this quote is summing up that if there's a lot of hype surrounding an initial public offering, it pretty much means danger, because eventually the public's just going to overvalue this company, which is going to lead to a crash once the stock sort of starts to find its fair market value. Same thing too with like Airbnb. They were offering shares at $68. That was their IPO price, and now I believe they're around 140 at the making of this video. I'm not 100% positive. I think it's around there, so they more than doubled. But it's super hard, like I said earlier, to get your hands on these shares at the advertised IPO price. So, I mean, you're likely going to get them at the 120 or after they doubled. And so, like I said, this overvaluation of these companies causes a collapse in the stock price later on. And so there are companies that absolutely skyrocket, like you see the articles. If you would invest $10,000 in an Amazon and whenever it came out, here's how much you'd make today. Like, that's great looking back in the past, but you wouldn't be able to pinpoint those stocks today. Microsoft and Amazon type cases are extremely rare. There's a lot more IPOs that lose money than there are that turn into these huge, very prominent companies. So personally, what I like to invest in are stable, big blue chip companies. They pay a good dividend that I can expect constant returns from every year to grow my portfolio steadily rather than seeing these sharp increases and then huge decreases afterwards. I just like a little bit more peace of mind in my portfolio personally. And those are just my thoughts on IPOs. Remember, though, I'm not a financial advisor, so you do your own research, make your own decisions with your money. If you think these prove great investments, go ahead. That's completely up to you. Don't let my opinions deter you from that whatsoever. You have to do your own research. So that's it for the video, guys. Go ahead and comment what IPO released this year you guys think has potential. Thank you so much for watching if you made it this far. If you enjoyed the video, please consider leaving a like or even subscribing for more types of these videos in the future. Thanks again, and I will see you in the next one.